We're live. UK Bank of England set to crash the UK property market as interest rates soar because inflation remains very, very stubborn at 8.7%. So yesterday it was announced that inflation did not budge after all the efforts. It stayed at 8.7%. And as a result, one day later, the policymakers of the Bank of England decided to raise interest rates from 4.5% to 5%, the highest it's been since the last crash, and putting a massive threat on the UK property market. So I think this threat is a macro and micro threat, so it's not going to threaten the whole. It's not going to threaten the whole of the market, but it definitely is a threat in certain areas, which we'll discuss further into here. But Rishi Sunak come into power just after the Liz Truss and Kwasi Kwarteng kamikaze budget, and ultimately one of their big goals was to halve inflation. Old Jezza and Rishi, however you pronounce his name, a lot of people are going to criticise me on that, but come ahead, the criticism. Their aim was to halve it. By this stage, by last month, they said they predicted it would be at 8%, so it's 8.7%, so you might not think it's far off. And by this month, if I've got the figures right, please put in the comments if I haven't got it right. They believed the market was going to go under, like, I think more towards 7%, and it's remaining stubborn. Bearing in mind, I'm pretty sure, I'd love to hear your comments below if I've got this right. I'm not sure if I've got this right, but I'm pretty sure that the inflation gets measured within the last 12 months also. So even though, like, we had the big spike in energy costs, but now that's not getting measured because that spike's already happened. So we're kind of going backwards, even though costs have still gone up, our cost of living's gone up, everything's more expensive, but it's going backwards. Look, I'd love to hear, do you think this is the right thing? Do you think the government should be pushing on rates? As the fact that people, like, one of the big factors is fuel, in my opinion. They're saying now holidays, they're saying the fuel's stabilised. Because it's stabilised doesn't mean it's not still much more expensive. Wholesale prices of fuel and gas and everything have come down, but have not been passed on to consumer. The frustrating thing as well with this is interest rates have been passed on to consumer in the likes of loans, credit cards. Let's try and cover that up so there'll be next out. Our credit cards, our mortgages, that's getting pushed on, but interest rates for savings is still ridiculously low in comparison. So the banks are quick to pass that on. But if the wholesale of energy, in my view, look, I believe it was France, so one of the countries, what they done is they put a cap on the energy providers putting the price up too much. Bear in mind, look, I'm not one of these people that's against big corporates earning big money because they put in big efforts, they put in big risks, and they need the big rewards to match that. They put in lots of money into the economy by making jobs, they help the economy, they help taxpayers. So I'm not one of these bash the Amazons and these big companies. Could they pay more tax? Maybe more, but I believe they deserve breaks for the effort they put in and the risk they take. But when the energy companies are earning record-breaking profits and the country's being crippled from inflation, and one of the drivers of inflation, look, you've got to imagine, getting goods and materials to shops cost money from fuel, getting heat in the shops, the fridges to keep the stuff cool, transportation. All of this is having a massive impact on inflation and prices going up. I believe it's the biggest hidden inflationary cost. They're saying inflation's 8.7%, but think about this. Like, your cost of energy was more than 8%. Your cost of shopping's definitely up more than 8%. So there's definitely a hidden factor in there. But look, is this going to crash the property market? Most of you that follow me are property investors or thinking about being a property investor. And the big question that we'll need to be asking ourselves, is this increase going to crash the market? And the answer is, I think it's a macro and micro effect on this. So interest rates, in my remote area, so I live in the south, but I invest in the northeast, and you've got to look at it. The average mortgage in my area, the average property price in my area is 145k, or around that sort of price, not bang on, and the average salary is around 31k. So it's within lines of their times multiplier of their income. So you've got to think about it. If a 100k mortgage goes up 4% from the 2% average what it was just over a year ago, they're looking at a like £200 increase. They've got 31k salary. When you look at the likes of London and average mortgages, the average price is over £500,000 and the average salary is around 37 or 39,000, depending on what website you look on, slightly differs. But you got to think their mortgages are going up £900 with these increases on the average mortgages. The energy bills have all gone up pretty much even across the country, but it's going to be harder hit in areas where price per earnings ratio is a hell of a lot wider. So look, this inflation's here to stay. Do you think the inflation is going to go up? Love to, again, this is the debatable video. Put in the comments, do you think it's going to hit 6%? There's a lot of commentators saying they feel it's going to hit 6% towards the end of the year. I'd love to hear your views. Where do you think that will put the property market? What you've got to imagine is a lot of people come off the end of 2-year fixes. A lot of people bought in the last few years. So do you feel there is going to be a major correction? I think there's going to be micro and macro corrections. Do I think there's going to be a major crash? I wouldn't have thought so because of the supply chain issues we've still got in the property market. But I do feel areas where your salary is a really wide gap from your earnings, your earnings and salary, is a really wide gap from the purchase prices of the property. I feel these are the areas that are under threat the most. But look, I want to jump on with a quick live. Love to get your views, and I will try and answer as many comments as I can. So please put in the comments what your views are. But it's super important to find areas of properties. There's going to be massive opportunity in this time. Loads of landlords selling up, loads of people. There's going to be more actually repossessions coming this way, which is sad, but it's a fact. So there's going to be tons of opportunity. So being in the right place for the right opportunity is absolutely key. Remote property investing for me is key because these properties, look, rates have gone up. Like, after I had a property that's empty and it was rented for 425, I bought it for 56k. The mortgage on that, I can't remember off the top of my head, was, I don't know, around 120 a month. I've not come to the end of my fixed term because I got it fixed, but when it comes to the end of these fixed terms, I was on about a 3% mortgage. Just say I get a 6% or just above. Let's say 6 for easy math. That's going to go up to 240. We've just rented that property now out for 675 because loads of landlords are exiting the market. So my rents have gone up a hell of a lot more than the property prices, even with the increasing rates. But the area has got the flexibility and the cushion in it to be able to suffer that because the yields are so high. In areas where the yields are not so high, like I've got a property in Southend-on-Sea, for example, the rates are 5%. The mortgage is £500 a month on that. And if the rates double on that, then I'm looking at £1,000. It only rents out for about £1,200 a month on the open market. So you can see how them properties can get me in major amount of trouble quicker if I had a full portfolio of those. But what I've got is an all-weather portfolio, which I've got loads of stuff that's higher cash flowing, higher yielding, with some of the stuff that's maybe not so protective, but a lot of equity in there. So I'm positioned to weather this storm. I've only got about 55% lending against my portfolio as well, so I'm not over leveraged. So I'm here to weather this storm and take the opportunity as it arises. So I'd love to hear how you're positioned, what your plans are going forward. We are definitely still buying. As I said, the rents have gone up much more than the mortgage rates in my area because it's marginable compared to the prices of these properties. The prices are still sticking a bit, still quite competitive. We're not seeing no major drops, but I'd welcome that if we can buy properties cheaper. But that said, we are still very actively buying. So I'd love to hear your views. Stick it in the comment. But listen, if you don't involve your ideas, you'll never live in your own terms. More millionaires are made in recessionary times than ever before, but it's about educating yourself. So make sure you follow this page if you don't already to keep up to date with the updates and what we're doing and where the market's going, and involve your ideas to live in your own terms and have an amazing day.